Welcome back to the Dividend Diplomats YouTube channel, everybody. You got your boys here, Lanny and Bert, the Dividend Diplomats. Guys, you know what we're talking about today? We're talking about a company that was beaten down during earnings. Their guidance was beaten down during this last earnings release. But you know what? We're not giving up on this Dividend King yet. And that's what we're going to talk about in this video and explain why.
Guys, before we dive into this stock, please subscribe, like this video. Getting closer and closer to 20,000 subscribers, guys. Bring out the real American right now, because I am a real American. Because, bro, what dividend stock are we about to talk about here that you own 200 shares of? I do own over 100, so full disclaimer there.
We're talking about that Hogan, Leggett, and Platt drop, ticker symbol LEG. Wait a second, Lanny. Is this the third straight video where we've had stocks where the tickers match the company's name? We had eBay, ticker symbol eBay, UPS.
Well, Leggett Platt is the company's name. You really people are calling them Leg.
Yeah, I'm calling them leg. I'm
Doing
doing it. This guy's doing it, and that's all that matters.
it.
That's all that
See, at
matters.
least when you see UPS truck, you don't go, "Oh, there's the United Parcel Services truck."
You might, just like when people
I
see FedEx, they
doubt
say
it.
Federal Express. Here they come.
I doubt it. I freaking doubt it.
Yeah. Yeah. All right. Well, anyways, so maybe not. That might have been a stretch. And that might be the only laughing we
Full
get in this
stretch.
video. A little bit of a stretch.
Yeah, I don't think anybody's buying their car going, "Oh, I think there's some leg seats in here."
All right. All right. Fine. Whatever. Whatever. All right. So what happened in their sales? They were terrible. Q2 sales were 1.22 billion, down 8%. Volume was down 6%. That's pretty much it. The good news, acquisitions added 3% of sales. So those acquisitions were accretive to their sales like they told you when they did
Yeah.
it.
But what they didn't say is it added to their net income. So full disclaimer there.
Yeah, they talked about the sales. So let's talk about EPS. Their Q2 EPS was 38 cents, down 32 cents from last year, which was 70 cents. So wasn't the best quarter. Their margins were down. Their EBIT margins were down 320 basis points to 7.5% from 10.7%. There just was not a lot of good news.
Well, but they did lower guidance as well.
The good news is the positive spin is there's more certainty on their guidance. It's just a little more lower certainty than there was what we were hoping for. So management downgraded their sales. So sales dropped to 4.75 to 4.95 billion versus 4.8 to 5.2. So down 4%. Volumes down. Raw material costs were down, so there's good. Some of their earnings per share, adjusted EPS, are now 145 to 165, down from 150 to 190. So, hey, it is what it is. Just not a lot of good news here from the earnings, despite the fact that they still showed positive sales. They still showed positive earnings. So, just
Despite they increased that dividend earlier this year, guys, let's get some positive movement here. Bert, you own 200 shares. You're doing another recap on Leggett and Platt. Again, a high flying dividend yielding wheeling and dealing stock right now. And, you know, your earnings is being impacted right now big time. It sounds like they're divesting a lot, which, hey, that's an income statement impact when you divest. Typically, you're getting some sort of loss plus a lot of legal, consulting, all the fees wrapped into it. And that's the same thing on the acquisition side. Usually, when you acquire, there's a lot of fees and costs. So I'm sure that the small increase in sales from the acquisitions will actually be bigger and better, hopefully, in the future once they probably get out of some contracts and finally get some synergies going with those acquisitions.
yeah.
And we're going to look at it though, right? From the Dividend Diplomat stock screener, the three quick metrics is the price to earnings, dividend payout ratio, dividend growth, and then we'll look at the dividend yield as well on lag.
Yep. That's exactly right here, Lanny. So what we're going to do is run them through, and then we'll come back to why I'm not necessarily concerned after, which is going to be another piece of the equation. Let's run them through that first metric. The price is 30.55 at the time of the close. Again, we're using August 1st prices here. We're going to take the earnings per share. We're going to use right smack dab in the middle of management's range. We're going to use $1.55. So that gives you a PE ratio of 19.71. So, hey, not the cheapest still, despite all the headwinds, they're still not the cheapest stock. And if you use forward earnings are $1.81 per Seeking Alpha. that drops the PE ratio to 17x. So still not the cheapest overall, which was kind of surprising to me when we ran them through.
Guys, the dividend right now is an annualized $1.84. They just increased their dividend recently by 4.5% as well. So management's expecting in the mid range of $1.55, but they pay $1.80.
It's 118% payout ratio. It's above 100%. If we plug in next year's earnings here, the $1.81 of what we're expecting, that gives you just over 100%. So again, let's put a pin in this and we'll come back to this when we talk about the other part of this equation. So the payout ratio is not great. Let's talk about this dividend increase here for a second. Laney already said last increase is 4.5%. That's right in line with their 5-year dividend growth rate of 4.04%. And remember, they are a dividend king. They've increased that dividend for 50 plus consecutive years, which is huge for a company like Leggett Platt that isn't necessarily doing the best right now from the metric standpoint. They have that history of continuing to increase the dividend through tough economic cycles.
Well, guys, let's look at the dividend yield for Leggett Platt. Are you getting paid for the potentially high payout ratio and dismal earnings release? Maybe. Right now it's 6.02%. They were trading in the 28s. You could have grabbed the yield a lot higher than 6% in case you wanted to secure some, almost 7% yield at one point. So 6% is the dividend yield, which, is obviously higher than the historical average as well.
And they're down 6% year to date, and their 1 year's down 23%. Very reflective of what we're seeing here in the earnings release. That shouldn't be much of a surprise to anybody.
Leggett and Platt, guys. So Bert, what are you doing with your 200 shares? You still holding, dripping? What's your plan?
I'm holding and dripping. So I've been teasing that there's a reason why I'm still holding on to this king. And it really comes down to the debt. And it's not just about their debt levels because they have $2 billion of debt. The piece is they've managed their cash flow within the debt so that they don't have any significant maturities. They don't have any significant payments until November 2024. We mentioned this in an earlier video about them. So they're not going to be facing a tough decision until the end of 2024 of how are they going to fund a massive debt repayment, or are they going to have to take out more debt at a much higher interest rate? They have bought some time from that where they're only paying interest right now. And I think that is key, especially for a company that has a payout ratio around or above 100%. It's managing that component is going to be critical.
Yeah. I think they better have a balls to the wall 2024, guys. They better have a great cash flow and earnings and sales. Hopefully management has a great projection put together and they execute on that strategy because, not to say I'm selling my shares, I'm holding, I will drip for now. But I'm not adding to my leg stock at the moment.
No, and look, I mean, if somebody says I want to set an exit strategy that's much higher, that if they bounce back and you want to get out from underneath position, I get it. Like it's not like it's sometimes what I wish I would have done with my AT&T position back in the day instead of just going all in. I'm not saying I'm married to Leggett and Platt forever, but the metrics, despite the high payout ratio, aren't screaming you need to dump this right now. There are some positive signs buried within them because they are in a very niche market and they are the major player in a high barrier to entry industry. Like it's hard to unseat Leggett and Platt from the sectors that they dominate. You're not going to do that.
Ooh, is that a little pun?
Unintended it was, but you got that right. So let us know what you think of Leggett and Platt right now. Are we being too rosy and too optimistic? I want to hear it too, if your thoughts there, because that's just as important too. I'm invested in it. I'm not advocating you make your own decision based on the metrics though.
Well, guys, that is the Hogan leg drop for today's video. Again, a 6% passive income producer for now. Do you think that they will continue to perform? Do you think they get back on track from just a performance standpoint? Let us know in the comments below. Let us know if you have been adding to your leg position. And again, what your thoughts are on this stock.
If you haven't already, subscribe to the channel. Give this video a thumbs up. And remember, if you're not with us, you're against us, Jack.
That was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.